Hi, Craig. I'm going to promote you to panelist. Good. There we go.
Have you got me?
I have got you.
For that, I can only apologise.
Cool. Seems to be all right. I can hear you all right. You can see you all right.
Okay,
So all systems are go.
no problem.
I've just got a couple of bits of news to do, so it shouldn't be too long. Probably about sort of 10 past, maybe not even that.
Yeah, fine. And then I'll talk for 15 minutes, 20 minutes, and
Yeah.
then see. And then you're just going to get questions through on
Yeah,
something that I can't see, right? Because it's going to
exactly.
be
Yeah.
on.
So
Yeah,
I'll
yeah,
just feed them to you. Yeah, that's right. Good. So if you don't mind putting this up on mute until we're ready for you.
yeah, absolutely.
Thank you very much. Talk to you in a bit.
Oh, James, do you want me to turn my camera off until you introduce me?
No, you didn't leave the camera on. That's all right, but it's up to you.
Okay, okay, fine.
The way it works, you can't really see you unless you're talking. So
Okay, no problem.
I say that, still see your video. Maybe just turn the video off for now, if that's all right. Cool. Okay, it's 11 o'clock. We may as well get going. So our guest this week is Craig Baker from Willis Towers Watson. He's going to talk to us about Alliance Trust. But before we get to that, I've got a couple of bits of news to look at. So Doric Nimrod Air 2 is coming to the end of its life, and Harmony Energy Income, which may not be far off. So Doric Nimrod Air 2 first. That is the whole chart, more or less, from when it started. Actually, no, it goes back a little bit before that, but you can see it used to trade at big premium. Everything was going quite well, and then it got hit by COVID, and I'll explain a bit more what happened there. And it went out straight at a big discount, but that's come back in again now. And you see there's a little blip here at the end. This is related to the news that happened this week. So it was launched in 2011, and it raised a decent chunk of money because it was the second one of these. Obviously, this one is called Doric Nimrod Air 2. Second one needs to get going. So Doric Nimrod Air 1 came to the end of its life relatively recently. The basic setup of these things is that they were aircraft leasing funds set up to buy A380s and lease those to Emirates. That was the basic structure of them. So it started off by buying 3 of them, and it was paying $234 million a piece for them at the time. Most of that financed by debt. And then on the back of that, it was comfortable in targeting a 4.5p a quarter yield, which is a 9% yield on the issue price of 200p. So that will seem quite good. So people were quite happy to give them more money after that. So they raised some more money in a C share, bought 4 more A380s. So again, so now they've got 7. The leases are all set up so they will run for 10 years, but they could be extended for 2 years. So the sort of periods for these all ended between October 23 and November this year. And the way that the structure was done, the income would pay down the debt. So you pay the interest and also amortize the loan as well. So there'd be no debt left by the end of the lease life. And actually, this fund has no debt at all now. So it was all going very well, apart from when we got hit by COVID. Obviously, the planes couldn't fly. People start to worry about whether airlines are going to go bust or not. And Medio Air 4, which is like a sister fund to it, had real problems because Thai did go bust. Thai Airways did go bust. All of Emirates A380s were grounded. It was still flying its 777s, but the A380s weren't moving at all. It could have run into real trouble, but the Dubai government stepped in and backed it. But even before this happened, people are starting to say, oh, the A380s don't really make a lot of sense from an airline's point of view. They're not really profitable enough. Unless you can fill them, they don't really work. And you need specialist terminal facilities to handle them and all that sort of stuff. So there was no real secondary market developing in the planes. And people looking at these thinking, well, actually, we're getting to the end of these lease lives now. And if we can't sell the planes, then a big chunk of the money that we were expecting to get from these things is going to disappear. So the board totally slashed the NAV. Basically, they took a big haircut to the end value of the planes, and that reduced the NAV. And then things sort of came back again, but even in March last year, 3 of the aircraft are still in temporary storage. The only good bit of news was they picked the right airline to partner with here. If they'd gone for Qantas or something, they would have been in real trouble. But Emirates said, we want to keep these things flying. They do work for us. So we're going to extend them for at least kind of 6 to 10 years beyond the end of these lease lives. And it kept on paying the dividend, the income to pay the dividends. So the dividends kept coming on this fund. But when you get to the end of the lease, because of this setup, the only real buyer in town was Emirates. So they paid $35 million for the first one and the second one, which I think is really quite cheap. You remember they paid 200. There were 243 million new, and they're only 10 years old. With that money, Doric Nimrod redeemed 2/7 of all of the shares in issue at 120p. But Emirates said we're going to start to retrofit all these aircraft with new premium economy products. So we're definitely going to use them. What we said about extend their lives, it's definitely true. We're going to do that. So by the time we get round to negotiating the price for the last lot of planes, they got a bit more for them. So they got $40 million ago. So $200 million is flying back to the company. So the debt's already gone. There's a bit of cash in there already. They're going to give most of that money out in the first quarter of next year, and they'll liquidate the fund quite soon after that. So actually, although it's been a rocky ride, it's actually been not a bad investment. So you pay 200p, you've had 224p back in dividends already, and I think we're going to make another 4.5p. You've had 57p equivalent on the first redemption, and I think you might get another 140 back next year based on how much cash there is and how much the liquidation expenses are. So that's a bit dubious. But against that, they're trading at about that price now. So there's not a lot of upside. I think even though it's paying more for these planes, Emirates are probably getting a bargain. You'd think you look at this and you look at the jump that DNA2 they've had and said, is there an opportunity elsewhere? DNA3's share price has already moved, so you've missed out on that one, and it's trading a whopping great premium. So basically, it's what's built into that share price is that you're getting these enormous dividends coming back, and so yeah, that's kind of eroding capital value at the same time. So you get the sort of playoff between those two. I definitely wouldn't be buying into DNA3. The more interesting one might be a Medio Air 4, but that's complicated because of what's going on with Thai and everything else, and I'm not going to go into that here. We haven't got time really. But that if there's one that's worth a look, it might be that one because that's still a big discount. Talking things on big discounts, Harmony Energy Income, almost 50 discount, only 110 million market cap. The reason it's not a big discount is because it's not paying any dividends. And the reason it's not paying dividends is because its profitability was nowhere near what it expected to be. They've announced this week the sort of quarter figures for the end of June. They've got some stuff that's still under construction, but they're saying that's almost done and they will be operational by end of September, they think. Some of this is down to contractor delays, so they're going to try and get some compensation out of contractors. I don't think it's going to be enormous amounts of money, but we'll wait and see on that. The revenue's been a bit all over the place, so that the way that they quote it always is in terms of what the annualized revenue would be based on the income from that period, whatever period they're looking at. So they're saying if you analyze the revenue they got in the 3 months of the 30th of June, it would have been £45 a megawatt. That's a bit down on what they were getting. And it's really down to the spreads that they can capture between the price for electricity when there's a lot of electricity being generated and the price for electricity when the renewables, the sun's not shining and the wind's not blowing and the renewables aren't generating, and you get these sort of big fluctuations. And if you can trade that using the batteries, then you can make a profit. Those spreads were much narrower in June and again in July, I think, but really between the lines there. But August seems to have picked up a bit, so that's helpful. It's still not enough, really. So it's no surprise that they're plowing ahead with selling the assets. And the interesting thing here is that they are saying that they think they're going to get non-binding offers before the end of September. Now you go back to that discount, 50%. To me, that says there might be sizable upside here. I mean, I can't guarantee that. We've got absolutely no way of knowing what people are going to bid first batteries because the revenue hasn't been anything like what was predicted. Obviously, they've brought the NAV down because to reflect that, but still it's still way up here and the share price is down there. Nevertheless, I think if they do get bids, they're probably going to come in well ahead of the current share price. We'll just have to wait and see. So that is enough from me. Now let's bring in Craig. So, good morning, Craig. There he is.
Good morning.
So thank you very much for doing this. As usual, I'm going to hand over to you for a bit and let you tell us all about Alliance Trust.
No problem at all. And good morning, everyone on the line. Yeah, I thought I'd just start off by a quick reminder of what it is Alliance Trust is trying to achieve and how it's set up and what we think are the key benefits of the trust. Then I'll give you a little bit of an update on recent performance, what the portfolio looks like, any changes there have been, and then, of course, touch on the recent announcement of the proposed combination with Witan as well. So just starting here, this is ultimately the objective of the trust, and that is that it's to deliver a real return over the long term through a combination of capital growth and a rising dividend. Our view is that if we do that over the long term, that will lead to significant outperformance of the MSCI All Country World Index, which is ultimately the benchmark that we compare ourselves against. Just as a reminder, this is a multi-manager approach within global equities. And so we're looking to find the very best stock pickers in the world. We ask them to run highly concentrated portfolios, so typically a maximum of 20 stocks in their portfolio, just give us their very best ideas, and ask them to think about risk in terms of permanent loss of capital rather than risk relative to a benchmark or a peer group in the short term. We worry about the risk relative to those things in terms of how we blend the various managers that make up the overall multi-manager portfolio. And we've been running the portfolio on this basis since April 2017. So if we flip on to the next slide, what we talk about here is what we think that leads to as a real edge relative to some other global equity investment trusts that you could invest in. So the first thing to say is that we are finding who we believe are the world's best stock pickers, and we're just getting their very best ideas. So there's real conviction in this portfolio, although we end up with 200 stocks, and so there is diversification, and there's definitely diversification by style, so you're not biased to any one approach that a single manager approach would give you that only works in certain types of market environment. Here we're actually diversifying across a number of stocks, a number of managers. However, within that 200 stocks, every single one of those stocks is someone's very best idea, and they know that company inside out and have spent a lot of time uncovering all the issues and really understanding the true growth drivers of that company. So that's really what it's about, and you end up with active money, so how different the portfolio looks relative to the benchmark, that's much higher in this multi-manager approach than you even find in many single manager approaches, whereas certainly much higher active money than you would get in a typical multi-manager approach, because the two things that multi-manager often have as a problem is that they become over diversified. Well, we stop that with this high conviction approach, or they become too expensive. Well, actually, we've been able to do this at a very compelling cost of around 60 basis points OCR. And that's really because WTW advise on a few $1 trillion of assets, and hence have real bargaining power with the asset managers that are out there. And of course, Alliance Trust is a large trust as well. We're able to bring managers that you wouldn't necessarily be able to access any other way in retail space. So some of them are available in UK retail space, but not in this 20 stock best ideas approach. And some of them aren't even available at all in UK retail space. So that's really what we're bringing, just scouring the globe with our team of 80 manager researchers, just going out there and finding those best managers, whichever area of the market they work with. And then we do that in a way that allows the board of Alliance Trust to continue with its progressive dividend policy. And it is a dividend hero that's been increasing dividends year on year for some 57 years. And we're not going to be the ones that stop that going forward. And then finally, we do all of that within an approach that embeds sustainability thinking and climate issues in particular. And so we're doing that from a perspective that having a better understanding of all the sustainability risks and opportunities leads to better returns and lower risk. So that's the principle behind all of this. So not only do we look for managers that think that way and really understand those risks, but we also employ EOS at Federated Hermes as a engagement overlay specialist on our behalf to engage with the companies that we're investing with to make sure they're following best practice in all of the sustainability areas. So if we flip on to slide 3, just a quick update on performance. So for those of you that aren't aware of how the performance has been going, 2023 marked very strong outperformance. We outperformed by in excess of 6% relative to the benchmark in 2023. We then outperformed again in the first quarter of 2024, but gave a little bit of that back in the second quarter of 2024, which was a tough quarter for active managers generally. To put this in perspective, 70%, well, I think it was actually 71% of the return on the MSCI All Country World Index came from 2 stocks. So that's Apple and Nvidia, a quite extraordinary statistic. And you can see here, therefore, the fact that even though we actually own Nvidia, it's in our top 5 holdings, we're underweight relative to the very large proportion it makes up of the MSCI All Country World Index. We don't have anything in Apple, or we've had very little in Apple. We've occasionally had a small amount through that second quarter, but significantly underweight Apple. Those 2 positions alone led to almost 1.5% underperformance over that quarter. To put this in perspective, in the first half of 2024, those so-called Magnificent Seven stocks, the big, large tech companies that have been driving markets for quite a few years, were 45% of the return on that index that has a few thousand stocks in it. And Nvidia alone was half of that, 22.5% of the return for the full 6-month period. Interestingly, the market cap indices typically perform in line with or worse than the equal weighted version of that index if you just had the same weight to each of the stocks that make up that market cap index. But there have been just 15 times out of 750 observations of this where the market cap index has outperformed the equal weighted index by more than 10% because it's been driven by a small number of very large companies that are disproportionate weightings in the index. And the first 6 months of 2024 was one of those. That's about the most extreme it's ever been in history. So that's kind of a bit of backdrop as to the very recent performance. As you can imagine, it was the growth managers that had done a bit better, and the value managers had done a bit worse within our lineup over that period. GQG in particular had done particularly well. Some of the value managers had struggled a bit more. If we flip on to the next slide, just putting that in context though, we have still got strong performance over the 3, 5, and indeed now 7 and a bit years that we've been managing this portfolio. It's been tough to beat the index. Most active managers have struggled, and you can see that by the fact that over that 3 and 5 years, we've done just above index, but that's significantly above the peer group in each of those indices. And we've done that with much lower volatility because of this multi-manager approach, where we take out that style problem and really just give you the strong stock selection that's coming through from each of the managers. If we then flip on to the next slide, what we've got here is the current lineup by manager. and you'll see there's 10 managers, actually 11 portfolios. GQG run 2 portfolios. So excluding GQG, all of the others run a best ideas, maximum of 20 stocks, some of them, more like 10, 15 stocks, but maximum of 20 stocks, go anywhere, find us your best ideas. Now, naturally, some of them are a bit more focused in some areas of the market than others. So whilst most of them think genuinely globally, a couple of them tend to have more in the US. So Lyrical, for example, tends to be focused more on the US, as does Vulcan. And Dalton focuses on Japan, but the others are global. GQG run 2 portfolios for us. So one is that best ideas go anywhere, truly global portfolio. That's the 15% allocation. And one is a specialist emerging market portfolio. So that's the one portfolio where they're allowed to own more than 20 stocks. And we do that purely and simply because if you didn't have a specialist emerging market portfolio in there, you would end up with a strategic bias away from emerging markets, because most of the managers, even though they're allowed to invest in emerging markets, wouldn't put as much in an emerging market stock in a highly concentrated 20 stock portfolio as they would in a developed market stock. And so we just make sure that our returns aren't going to be completely thrown by whether we've got a lot less in emerging markets than the benchmark. So that's the makeup. Most of those managers have been in place for quite some time, a number of them for the whole 7 years that we've been running this portfolio. The 2 most recent additions are Dalton, who we talked about on a previous show here. They joined the portfolio in the second half of 2023 as a Japanese specialist, us wanting to really take advantage of the opportunities in that market that have been opened up by some regulation changes, really pushing companies to do the right thing for shareholders. And there's a lot of pressure on companies that are running at a price to book value less than a certain level to actually set out their plans for increasing shareholder value. So we think there's lots of opportunity for long-term bottom-up stock pickers in Japan, and throw in the fact that the market looks relatively cheap relative to history, and the currency looks relatively cheap relative to history, and that looked like an interesting manager to put in, particularly given that we were actually underweight Japan prior to adding them. So that came in the second half of 2023. But the more recent change is ARGA coming into the portfolio. So maybe if we flip to the next slide. This was really an opportunity to replace Ben Whitmore at Jupiter, who came out of the portfolio, and this was done in about April this year. Now, many of you will be aware that earlier in the year, Ben Whitmore announced that he'd be leaving Jupiter in the summer to set up his own firm. We've been with Ben since the start of the Alliance Trust portfolio. We continue to think Ben is a highly skilled individual. We will continue to research him in his new organization. But the beauty of this multi-manager approach is that we don't have to follow Ben day one. We don't have to necessarily stay and have a different portfolio manager at Jupiter. Instead, we just took the opportunity to take the money from Ben's portfolio, which was less than 10% of the total assets of Alliance Trust, and put in place a manager that we've been positive on for a long time. So I've personally been researching Ramakrishna, who's the leader of ARGA, for over 25 years. I used to research him back then as an emerging market manager at Citigroup back in the day. He then became a global equity manager. He worked at Xena for a number of years, and then started ARGA a number of years ago, over a decade ago. And we think they're a really high quality global equity manager that has particular skills in the emerging markets as well as developed markets, value-oriented investor, not just invested in the typical large cap stocks. And so we thought a good fit for the portfolio, a lot of similarities to the way Ben runs assets, a bit different in other ways. Ben obviously started life as a UK equity investor and became global. Rama started life more as an emerging market investor and became global. So they come at things slightly differently, but certainly the value discipline and the fact that they're willing to go anywhere is similar to the two organizations. But we think some real strength of analytical depth here with Arga, particularly strong on some of the sustainability side, really do understand the climate risks that the various companies that they're investing in run as well. And so we thought just a great opportunity to bring them into the portfolio at about an 8% weighting. So they've been in for a few months now, but that's the only change to the manager lineup in 2024. The other changes clearly have just been around weightings, and we always take the opportunity to evolve the portfolio by weightings. Most of that is the principle of rebalancing. So what we want to do is make sure that we're not running a style bias in the portfolio. So if one style is doing particularly well, so growth has been doing particularly well for a number of years now, if you didn't do rebalancing, all of your growth managers would have performed very well, your value managers less well. You would have ended up with more in growth. You'd have a big growth bias after such a run. We're typically taking profits from the managers that have performed well and adding money to those that we think are still skilled. They've been doing well within their style, but their style has been out of favor, and hence they've underperformed in recent times. And so that's typically happening in the portfolio. And as a result, what you tend to find is that our weightings look as though they haven't changed much, but actually, in order to do that, we've had to actually be taking profits and giving money to the weaker performers. If we now flip on a slide, this just points out what hopefully has come across, that we try to always make sure it's stock selection that's driving everything. We've picked these stock pickers as long-term fundamental stock pickers that really understand their companies. We haven't picked them because we think they're good at calling markets or calling currencies in the short term or anything like that. So what we do is we blend them, and that's mainly where the weightings come from in these managers, in such a way such that from a top-down perspective, the portfolio looks pretty boring. It looks, pretty close to what the benchmark looks like. The only real bias we tend to have is that we're on average a bit underweight the larger mega cap and overweight the sort of mid cap area, just because if you ask people to find their very best ideas in the world, on average, they're not the ones that are the most highly covered by the sell side research and have gone up the most by definition, which are the largest companies in the index. So we tend to have that slight bias in the portfolio, although it's not enormous. But other than that, we never have a structural bias to growth or value. There might be at times where you've got a minor bias just by how the portfolio looks at that particular point in time. But generally, we try to keep that neutral. We want stock selection to come through. So what you tend to find is that at a country level, at an industry level, at a style level, it looks as though we're very close to benchmark. At a stock level, we look completely different to benchmark. And that's how we keep that active money well over 70%, which is incredibly unusual, almost unheard of in multi-manager space, actually relatively similar to what you get with a pretty punchy single manager approach, but without all that style bias. If we then move on one more slide here, just want to touch on this point of Magnificent Seven having really driven markets for quite some time now. We've been on average underweight the Magnificent Seven through that 7 years. There have been times where we've been close to neutral, times where we've been more underweight. At the moment, we are more underweight than we have been for some time. But it's still never going to dominate our portfolio. We're not just going to have only whether the Magnificent Seven go up or down is what drives our portfolio. So we do have exposure to the Magnificent Seven, but we are in aggregate underweight. We're overweight things like Alphabet and Amazon. We're underweight all of the others, and in particular, Apple, and then to a lesser extent, Nvidia, albeit that we've still got a reasonable weighting to the latter of those. But it is important to note that if you go back and look at the index over the various decades, there's always been a small number of companies really dominating the index. And there's always been talk about these are now going to be the ones that dominate for the next 20, 30 years. The reality is that very rarely happens. You'll see such significant change every decade in what the leadership is. And that's not always because those companies turn out to be bad companies. Often they continue to be fantastic companies. But it's just the market got ahead of them and the valuation just got stretched in a number of those. And I don't know which ones are necessarily going to be the ones that that's going to be true for over the next 10 years. But I'm pretty confident that the same companies dominating the market today won't be exactly the same companies dominating it in a few years. And so we do think there's a real advantage to active management normally, and we've certainly got a track record over the long term of significantly outperforming over the long term. But actually at the moment today, there's a good reason for not wanting to necessarily tie yourself into a very highly concentrated index as it stands today, probably more concentrated than it has been in some of those previous decades even. And of course, if you look at the makeup, all of those stocks really are in the same area of the market, whereas in some of those previous decades, there was a bit more of a diversification as to what kind of companies were driving the market at any point in time. So some dangers there potentially about passive management. Now, that's not to say I'd be negative on passive management. I think it's a very good option rather than necessarily a single approach with a single manager that's going to come with all sorts of volatility. But we do think this blended approach of the world's best stock pickers, taking out that style problem, at the moment, when you've got such a highly concentrated portfolio, looks particularly attractive. And certainly that paid real rewards in 2023, and we think is going to continue to do so from here. If we just flick on to the outlook before I touch on the more recent announcement about the potential combination with Witan. We still think some macro risks remain high. There's a lot going on. We've got a US election coming up that brings uncertainty with it. We've got a new government in the UK. We've still got the war between Russia and Ukraine. There's all sorts of geopolitical issues going on elsewhere. There are risks remaining high from a top-down perspective. Now, we're incredibly excited about the portfolio from a bottom-up perspective that we've got, and we think it looks as though it's got some real latent value there, more so than in lots of periods in the past. But we are cautious at a top-down level, and so whilst not negative on equities, we are at the lower end of our typical gearing range on the trust as it stands today. So we're typically in the 7.5 to 12.5% gross gearing. We're down more at the sort of 7.5, 8% level as we stand today. But we think volatility in markets that's likely to be around the election, what happens to interest rates and inflation, that's going to throw up great opportunities for long-term stock pickers. So we're genuinely excited about that. And of course, because we're with managers that think about long-term fundamentals, that's going to matter even more with interest rates where they are today than when there was almost free money for a long period of time before those interest rates rose. And so we think that's going to come to the fore in the portfolio. So that's really it on the portfolio today before we get to questions, but I have got a final slide that just touches on the recent announcement about the proposed combination between Alliance Trust and Witan. So the backdrop here is that Witan have been following a multi-manager approach for a long time, and that's been run for some time by their CEO, Andrew Bell, and his team. It was announced earlier this year that Andrew Bell will be retiring, and so the board of Witan opened it up for people to come with proposals on how they should manage the trust going forward. They received a huge number of proposals from managers, most of which, of course, were single manager approaches, but also multi-manager approaches, one of which was Alliance Trust and WTW bringing the opportunity to the table of, well, why not take the opportunity to combine the two trusts? And the board agreed with unanimously that this was going to be the best approach going forward. So we're in the process now of putting out the prospectus for shareholders of both Alliance Trust and Witan to vote on those proposals, and we would hope that those votes will go through and there'll be an opportunity in the fourth quarter for the two trusts to combine into one trust named Alliance Witan. We think that's got massive advantages through economies of scale. In the investment trust world, we're really looking for direct investors. That costs money to advertise, get people to know your brand, continue to build that out. The more assets we've got, economies of scale, the more we're able to do that, which is beneficial to existing shareholders because that would bring the discount in, potentially move that to a premium over time. Throw in the fact that here, this would lead to assets in excess of 5 billion as today's asset sizes, which would likely mean a FTSE 100 inclusion for the Alliance Witan Trust, which would increase the profile even further, and of course potentially increase liquidity further, making maybe it more open to investors that wouldn't otherwise have invested, be that small institutional investors or, more realistically, the big wealth managers that could only really invest in the larger investment trusts if they're going to be able to put that across all of their clients at a particular point in time. But there are other advantages to this deal for shareholders. Planned increase in dividends is linked to this. The third and fourth interim dividends would be increased quite significantly, and then of course continue that year-on-year increase thereafter. All of the costs of this for shareholders would be covered either by a fee contribution from ourselves or the cash tender exit in the case of the Witan shareholders, and so this should be NAV accretive, certainly not NAV dilutive. And for Alliance Trust shareholders, no change in investment approach whatsoever. WTW will continue to run the portfolio in exactly the same way going forward, just under the Alliance Witan brand rather than the Alliance Trust brand. So that's really the key things I wanted to get across, James, but I know there'll be some questions coming out of some of that.
Yeah, no, I think we've got a few already. Let's start off with the kind of macro-y type things. Obviously, against the context of what you said about trying to keep it all neutral, do you think the US market, and in particular the sort of AI type things, might be overvalued?
Yeah. So we certainly think that the market is potentially ripe for a bit of a correction. Now, are we sitting here saying we think this is massively overvalued, you should be massively reducing your equity exposure generally and so on? No, we're not in that position. We think the fundamentals are still pretty strong, but the US has had such a good run that we do think there's the potential for a correction there. We are, we don't run big country positions, but we are underweight US equities. A lot of the managers are finding opportunities outside of the US that they think look particularly attractive. We actually spend a fair bit of time making sure that that underweight doesn't get too big so that it's driving performance. So there's certainly the potential for a bit of a correction there in the US. Obviously, there's quite a lot of uncertainty given, kind of pretty much almost 50-50 with who's going to win the presidential election in the US, and that will have different implications for markets. But we think there's the potential for that, and so the portfolio certainly is set up in that way, but it's not taking it as a big bet because the one thing we've learned over the years is that generally it's pretty hard to call top-down things. It's much easier to find companies that look attractive on a 5-year time horizon and own those and not worry too much about what happens to macro, and just make sure your portfolio won't be hit by any of those.
And then sort of counter to that, a lot of people have been saying for a long time that UK is cheap. You took Ben out, which is obviously, I guess, had a UK bias. Do you want to sort of try and encourage a UK overweight at the current point in time, or not?
Yeah, well, we certainly don't tell the managers what they should be doing, but clearly we have an element of ability to move the weightings to those managers to reflect that. You can see there that we are overweight. The UK is a bit less than it was when Ben was in the portfolio, but not massively so. So when Ben came out, we did tweak some of the weightings to various managers and make sure that we weren't significantly changing the nature of the portfolio. So it does remain overweight UK equities.
Okay, cool. And what about small cap versus large cap? I mean, again, you've got a slight sort of small cap bias, but it's not huge. Small caps have been lagging lots of markets, but they seem to be doing a bit better very recently. How do you think about that going forward?
Yeah, so you're absolutely right. I mean, small cap. I mean, basically, it's almost been anything versus mega cap rather than
Yeah.
small cap per se. But yes, it's lagged for a long period of time now. I mean, it's a much bigger difference than you've seen over virtually any period that you want to look back at. So there's certainly an argument for that looking as though it's an undervalued part of the space. As you say, we are underweight mega cap, large cap. We're a bit more overweight mid cap than we are small cap per se, although the definition of mid cap, small cap differs by country. But we would definitely benefit in this portfolio should there be a shift towards that. As you say, that's happened a little bit more recently. But still a long way to go in that differentiation between the two. But again, what we don't want to do is have it such that that's a big bet in the portfolio. We would have thought that would have been true a year ago, 2 years ago, and it's continued to run on. So these things are just very difficult to call timing wise. We'd rather let the stock selection drive it.
You might not want to say, but you mentioned elections stuff coming up. Would one president be better than the other for markets, do you think, in the US?
It's a difficult one. We did a bit of analysis as to what areas of the market have tended to do well when the probability of a Trump win versus a Democrat win has been on there. It's a little bit difficult because it's obviously previously it was a Trump versus Biden situation rather than necessarily the latest situation. But nonetheless, you can look at which areas of the market have been correlated with it. So after the you saw the presidential debate where after that the odds on Trump winning went up quite significantly. You can see what happened to markets. The domestically focused stocks did particularly well. On average, the market did pretty well on the back of that, and things like renewable energy did poorly. You'd expect some of those things, but actually, if you look at a lot of the statistics historically, they tend to show that it almost doesn't make a lot of difference who the president is if you take a decent time period. That's not to say there wouldn't be a reaction in the short term, but it probably won't make a huge amount of difference to the fundamental picture if you're a bottom-up stock picker. But certainly, you would see more of a domestic focus with a Trump presidency, given the likely tariffs on certain things and the focus on domestic side, and a bit less obviously on the renewable side of things than if it was a Democrat one. But in terms of which would lead to better outcomes over a long period of time, difficult to call that there'd be that much difference.
Fair enough. The other big thing that's going on, obviously, is that we've had an interest rate cut in the UK. We're expecting one. Hopefully, will come in the US in September. It'll be interesting if it doesn't. Is that going to cause a shift between who does well in terms of growth and value?
Yeah, I mean, obviously, the big thing that matters is whether there's a change in interest rates that's different to what's already expected, because whatever's already expected is in the price. And so if markets see interest rate cuts being exactly in line with their expectations, it won't make any difference to where we are today. But you're absolutely right that if rates are cut more slowly than is expected, that would probably help value versus growth, and vice versa. So it'll be interesting to see whether inflation turns out to be a bit more sticky than the market's expecting, and hence rates stay higher for longer, or whether rate cuts accelerate. That is going to be an impact on that value growth piece. But ultimately, so will just a view on AI, because AI theme really has dominated, all of the growth areas, even if they're not anything to do with AI, seem to have been moving kind of lockstep with what the view is on AI. And so you just get things like when NVIDIA's next announcement comes out, it has an impact on lots of sectors rather than just their share price. So we'll see whether what impact that has. I mean, clearly AI is going to be something that is going to have a massive impact. The bigger question is, does that have a big impact more on the typical technology areas that the market has been focusing on, or whether it has a really positive impact for other sectors of the market, and what that means over the course of the next few years. And that's really why you can get these situations where the leaders each decade have changed, because even if the theme was obvious, like the internet and so on and so forth, it's not always obvious who are the biggest beneficiaries from that.
Assuming that the Witan deal goes ahead, and obviously we all hope it does here, what will happen to this portfolio? Will all those pools just get a bit bigger, or will there be a new pool in there, or a new couple of pools?
Yeah. So, so in general, you would expect it to look very similar day one to this. But of course, we take the opportunity to look at the portfolio, and we're always thinking about, can we improve the portfolio at any, that's our job every day, to come in and say, if we were starting from scratch, could we build a better portfolio? And so we would take an opportunity to look at all the managers that are in the Witan portfolio. By the way, there are two in the Witan portfolio that are also in the Alliance Trust portfolio. So Veritas run a global equity portfolio for Witan in the same way they do for Alliance Trust, and GQG run an emerging market portfolio for Witan in the same way they do for Alliance Trust. The other managers are different, and so we will take that opportunity. But of course, we know all of those managers already. We like lots of the managers that are in the Witan portfolio. So it's less about, do we like the managers? It's more about, do they add something to this portfolio? And our BAU views on the managers. Have we found a new manager that we want to put in the portfolio? All that, we'll take it into account, and we'll probably do one trade at the same time. So yes, you can expect minor changes to this, but the majority of it will look similar to this day one. We'll still follow that 20 stock type approach. So Witan have got Veritas, as I said. They don't run a 20 stock portfolio for Witan, so they would for us. So that would be a little bit of a change in their portfolio. But as you say, generally most of these managers will end up with a bit more money. But we'll take the opportunity. We've always said we would expect between 6 and 12 managers in the lineup. We've got 10, so we've got the potential to add 1 or 2 managers if we want to, and we'll be looking at that. There is one thing I would just note, that Witan do own some investment trusts that are trading at a significant discount, some of them. What we would not do is just force a sale of those to fit what we normally do if they're at a big discount. So we will just take on those investment trusts and we will own them for as long as we need to own them. We're investors first and foremost. And we've got a track record of doing that. When we took over Alliance Trust back in 2017, there were some historic mineral rights, private equity, real estate. They owned Alliance Trust savings and the like. It actually amounted to about 11% of the portfolio back then. And we sold them over the course of a few years. We didn't just force sale them. We did it when it was in the best interests of shareholders. We'll do exactly the same here. But to put that in context, they make up less than 3% of the total assets that Alliance Witan would have should the deal go through.
Fair enough. That's helpful. Thank you. Just one question about Jupiter. So it's obviously the review of the position was triggered when he decided to leave Jupiter and go off on his own. Was there anything he could have done that would have changed your mind and let him stay in the portfolio, or was it more about the big picture about what he was doing and how that fitted?
Yeah, I mean, look, there's obviously when that announcement came out, we had a few options. One would have been to stay with Jupiter and have an alternative portfolio manager. One would have been to follow Ben to his new organisation. One would have been to just take the cash and give it to our existing lineup of managers, and one would have been to replace him, which is what we ultimately ended up doing. Mm-hmm. Quite frankly, all four of those are perfectly sensible approaches. It wasn't like, we're unequivocally not going to do A, B, or C. We thought about all of them, and we still rate Ben. But look, we don't need to necessarily follow him day one. We can look at how things bed down, how the team builds out, how the operational side of things are put together. We've got a big operational due diligence team at WTW that can go in and look into all of those. That is particularly heightened when it's a new organization. We can see how the team builds out and how the kind of teamwork goes on between the various individuals. So we've still always got the possibility of using Ben at a later point. Actually, I sometimes use this example. So Rajiv Jain, who is the key portfolio manager at GQG, we actually invested with Rajiv when he was at Vontobel back in the day in our institutional version of Alliance Trust. And he announced, very similar to Ben, that he was leaving to set up his own organization, but he was still going to be there for a couple of months. We actually took the money away from Rajiv, and we didn't follow him day one to GQG. We were actually in his offices day one when they still had boxes and everything, doing research meetings and the like. But we waited until we were comfortable that they'd built out the infrastructure, they built out the research team, and then we added GQG to the portfolio. Now, obviously, Alliance Trust started after that point, and so he came in day one on Alliance Trust. But it's just an interesting example that we did something similar before. Now, that's not to say we'll definitely put Ben into this portfolio or one of our other portfolios in future, but it shows that it's not ruled out, and we will continue to research Ben going forward.
Great, thank you. Just, I think one final question there, from me, because there's no more here on the board. About the gearing. So would you ever run that down? What's the sort of range that you use for the gearing? Would you run that down to 0 or?
Yeah, so technically we can. So the way it works is that the board have set us a strategic gross gearing level of 10%, and they say to us, you manage it however you want between 7.5 and 12.5. If you want to go outside of those ranges, that's fine, but come and talk to us as a board and we'll agree it, or not, but we'll agree that. So there could be a scenario where we think we're unbelievably negative on markets. We really think they're going to fall. We'd want to get that gearing down to 0. We can go and have that conversation with the board. Equally, it could be that after a fall in markets, we think it looks incredibly attractive. We want to go right the way up to 20% or more. We can do that, but we have to get board approval. And that makes sense because we've sold this as being driven by stock selection. We don't want it to be us swinging around the gearing and that's what's dominating returns. But equally, we don't want to be in a situation where we can't take advantage of an outsized position. Today, we're not sitting here, although we're at the cautious end and we're at the sort of 7.5%, 8% gearing, we're not sitting here thinking our central expectation is for a massive fall in equity. So we're not having that conversation with the board today, but there is the potential for us to do that should we ever get to that situation.
Great. Thank you very much, Craig. I think we've covered a lot of ground. Good luck with all of the combination stuff. And then we get some documents, I think, fairly soon, and then people get to vote. So we'll see how all that goes and get you back on again next year sometime.
Thanks very much. Nice to talk to you, James.
Thank you.
Bye.
So next week we're back talking to the manager of STS Global Income and Growth, which is obviously bigger than last time we talked to because it's absorbed Troy Income and Growth since then. And then, as usual, we've got a full lineup going all the way out to the end of the year. And we've got our quarterly panel show coming up on the 20th of September. So thank you very much for your time this week. Have a good weekend, and we'll see you next week.